Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today we're going to be analyzing Target stock. This one came in by request down in the comment section of one of my other videos. If you have a request of a stock you would like me to analyze, just drop it down in the comment section. I'll get the ticker on the whiteboard behind me and eventually I will make a video. If it's a stock that's in the S&P 500 like Target is, I post those on YouTube for free. The rest I post on Patreon, which is $5 a month, and in the full Cyclical Investors Club service over on Seeking Alpha. If you join Patreon, you can get a big discount to the full service. And there we have all the spreadsheets that you see me using here, lots of articles, explanations of my strategies. You can chat with me at any time. And then there's a whole other group of wonderful investors that are there. And we all kind of work together to try to find good investing ideas in the stock market. Those links will be down in the description if you're interested. As always, this isn't individual investing advice. This is just how I analyze stocks. With that, let's get into Target. So the first thing I like to look at are the historical earnings of the business. That's the dark green area here in this fast graph. And what we can see here, this is the earnings per share. During the last recession, earnings fell about 14%. And then they also had a year in 2014 where earnings fell 27%. I don't know for sure if this was the year of their data breach, but it might have been. It's kind of a weird time to have this sort of decline, but they immediately bounced back. So I would consider this a moderately cyclical business. And with those types of businesses, we want to take into account these down earnings years that occasionally happen when we calculate earnings growth, and also potentially look at price cyclicality. So if you look at how far they fell during the Great Recession, it was about 65%. That's a little bit deeper than the market. So you can tell that now some of that depends on what the PE is going in. They had a 21 PE going in and then a down earnings year, and you put those together, you can get that kind of a drawdown. Now if we look at more recent times, we'll get past that kind of tricky down year and then the recovery. So 2016 is usually a good place to start. And then we also might want to consider that the COVID period was very unusual for businesses. And I warned people about businesses like Target. I don't know if I know I did in the Cyclical Investors Club. I don't know if I wrote a public article. I think I actually wrote when it first started falling here, explaining to people what was happening because people still didn't really know. But in early 2022, I started trading out of stocks that I owned like Target. I didn't own Target at the time. But what happened was Target, and I think Best Buy probably too, they had pretty good online and pickup systems during COVID when people were actually locked down. And they also sell like electronics and home goods and the type of things that people bought when they were stuck at home for a while or had to work from home. So they actually had a big boost for earnings these couple years. This goes along with the stimulus money that went out as well. So these should be counted as a boom time. And that boom was followed by a bust. Additionally, companies, brick and mortar companies like this especially, they hired lots of people during this time. And labor was pretty short. A lot of people had to stay home and take care of their kids. So it was hard to go out and find labor, and they had to pay up for it. So they had to pay more for that. And then when the demand abruptly changed, they had a lot of that overhead still. And earnings fell back down to a more normal level, basically what it was pre-pandemic, a little lower than that, but really not too much. So this is really just a normalization. When estimating earnings growth, I don't remember exactly how I did it, but I'm pretty sure I just took this period here, which had about 5% earnings growth on average once any buybacks were taken into account. And if you looked back before that, we're not talking fantastic earnings growth here. There'd be a 10% year, and then a 3, and then a down, and then a recovery, and then a 10, So, and I'm pretty sure they had some stock buybacks that would have inflated these numbers too. So when I calculated it all out, it was about roughly 5% earnings growth. And then really what you have to do is say, okay, all this is normalized post-pandemic now. We're pretty much about to normal a little bit if you include inflation into if you take like $6.30 and 25% inflation or something like that. I'll just do that math really quick. You get almost $8 a share. That's about what a little more than that's what they're going to earn. You add a little bit of normal growth that would have gone along with it. And presto, you could have extrapolated this number out minus the 4 COVID years and got where we are today. So this looks normal to me. So I think using this number plus 5% earnings growth going forward is about the best way to do this. Now that's less optimistic than what the market has, but we'll see. This shouldn't really count as a recession, and we may have a recession. So I think it makes sense to be conservative because that 5% earnings growth doesn't really include a recession. Although, given that they didn't really lose too much in the way of earnings growth in the last recession, if that was a similar trend, it might be good for a recession too. I think it's kind of a good, like 5, maybe 6% earnings growth estimate. It's probably about where a person wants to be. Walmart, for example, they aren't growing at all. So that's pretty typical. Other department stores aren't really growing very much, or they're seeing these type of declines that Target is. So it's choppy, it's mixed up, but that's kind of where I think it's fair to try to value the stock. So without taking anything else into consideration, it's at a 17 PE. They do have a big difference between their total enterprise value, like 30% difference between the market cap and total enterprise value. Some of that could be like obligations like rent, I'm not sure. I'll give you one where I make this adjustment, and then I'll give you one where I don't, and you can kind of judge for yourself what you want to use. So, getting in here, I use 4.9 my earnings growth expectation with $8.36 of earnings this year. If you adjust the stock price for the debt, as I showed you, it would actually be at $184. And so that's what I'll show you here. And then I can show you what the adjustment looks like if you don't want to do that. So putting all that together, we have a 4.54% earnings yield, which is the inverse of the PE ratio. So earnings over price. So the way I think about that is if you bought the whole business for $100, including any debt and other obligations they have, you could earn $4.54 on your $100 investment per year, and that would grow at about 5% a year. So including your $100 over 10 years, that would grow to about $160. And that's money that's not reinvested. Like if you own the business, you could take it and go spend it. That's just what the business is churning out, independent of any kind of reinvestment. So when we do that, we get a 10-year CAGR of 4.81%, which is right around the sell range. Now, if we don't include like those debt adjustments I was making, it's like 6%. And if you took the difference between the two of them, that's about where the rest of the market is. So I would say it's pretty much valued the same as the rest of the market right here. If we just kind of split the difference on everything and kind of take the average of everything. Somebody might also give them a little bit more credit for analysts think earnings are going to grow faster than this. So like next year, they think it's 9%. If you do that, that's right where the market's trading at. So that could be the difference too. But to get to fair value, it would have to probably fall like 25, 30%. To get to the 8% that I would like to see, you're looking at 65.80 for the price, which is about 50% lower. If you use the recession PE, which isn't a big adjustment, that would be a little sooner, actually, at $77, because they didn't really well, they did fall quite a bit during the last recession, but relative, it's because the reason is because the peak earnings were so high. So the recession PE is measuring these peak earnings and then how far the stock price, where the stock price relates to those peak earnings. And because those peak earnings were so big because of the boom, it's a little bit more generous right now. So you can kind of think about it however you want to. I mean, either way, if you bought it when it was like 50% lower than where it is now, like 70-ish, anywhere in this range, 66 to 78, you'd probably do okay with the stock and get good returns. In terms of fair value, it's hard to say. I mean, probably like 90, 95 would kind of be the midpoint of fair value. I mean, so it's kind of boring. I haven't really been paying too much attention to it once kind of the story disappeared about this boom. But this was really clear for me to explain to people. It was a great example because you could just really see it clearly. Slow growth, boom, boom, bust, now normalization. So that's probably the best lesson to take away from looking at Target. Other than that, it's probably like valued the same as the rest of the market, which is overvalued. But it's going to be hard to go out and find a comparable stock that's undervalued. I mean, Walmart's way more overvalued than it. So I mean, I can just peek at it real quick. I don't think anybody's asked me about it. But if you look at Walmart over the same period, you have like negative growth. By the time you include buybacks, you have like negative earnings growth. I think on FastGraph it's 4%. When I calculated, it's no earnings growth, and especially if you go 2015, I think that's where I usually, yeah. So they earned $5 there. All this then lower forever. The COVID boom is the only thing that kind of saved them, and now their earnings are falling back down again. I wouldn't be surprised if they have stock buybacks in here too, and it trades at a 25 PE with no earnings growth. I mean, it's kind of ridiculous, really. So I think Target's probably actually cheaper than Walmart, but people feel safe when they buy it. They feel safe when they buy Walmart because they know Walmart. They know if people don't have as much money, then they're going to shop there more during like a recession. But the truth is, it's really just overvalued. I mean, I'm not sure. It wasn't even a 25 here. Yeah, so right here was the last time it was even close to this PE. And you've gotten 8%. The market's probably given you almost double that probably over that time. But at any rate, I think it should trade a lot lower, honestly. There's just not really much money to be made there. Okay, that's all I have to say about Target. If you have any questions, drop them in the comments section. If you found this useful, subscribe to the channel. If you have a request, drop it down in the comments, and I'll see everybody later.